Let me add Xavier up on here. Let's go. Where's he at? Right here. There you go. Yes, sir. Oh, we got video. Hey, see, yeah. See, it's easier than you thought. No. It sounds a lot clear. It sounds a lot more clear than the last one we did for sure. I know. I saw you. Yeah, you had a little trip out here, man. I was gonna hit you, but it looked like you was having fun though. I was like, nah, I'm gonna let him do his thing. Oh, let's go.
Business credit cards, even personal credit cards, personal loans. Been doing a lot of personal loans lately. Business lines of credit, business loans, pretty much anything people qualify for is what I specialize in. But
Okay.
yeah, man, thank you so much for having me on the live. I'm super excited to be here.
Oh, for sure, man. Yeah. So, like he just said, this is Xavier. He's the owner of Restore Funding. I saw he was doing some good stuff, man. So, we ended up linking up, and yeah, he does great business, good honest business. The type of business that me and my followers, and my team really like. So, but Xavier, so let's start it off like this, man. Can you let the people know that there's a huge confusion? People think that you can just get net 30s and go to Chase with bad credit and still get business credit cards. Okay. Can you debunk that for me?
Yeah, of course. That's classic, right? Yeah, I've talked a lot about this on like some of my live streams as well. And at the end of the day, I think the truth is that people believe what they want to believe. And Ben's point of view is that getting a net 30 account, you go to Quill, Uline, Granger, whatever, you buy a whiteboard for like $50 and you pay it back 30 days later. That's just the truth is that's too easy.
Yeah.
Like the banks are not going to give you $50,000 because you paid off a whiteboard 30 days later.
Yeah.
Thing, you know what I mean? And so, yeah, I'm a big believer in personal credit, especially if you're a startup. You really need to have good personal credit. Whereas, if you look up business funding and how to get business funding, there's all these courses and things like that online trying to sell you how to do these net 30s and net 60 trade lines. But at the end of the day, I mean, I've run a lot of applications. I've helped a lot of people in the last year, get approved for a lot of funding. And I have never once in the space. And yeah, I hope this isn't like contradictory to anything you teach, bro.
No.
I've personally never once in the space seen someone get based on their, paydex score. Like the banks might look at your business credit, but at the end of the day, you don't need to have very developed business credit. You just need to not have a bunch of business late payments and stuff like that. Like you get a business credit card and then start missing all your payments. That's good enough. Other than that, though, the banks are always going to be looking at your personal credit, which is really such a stronger indicator of whether you can pay back a loan. Because paying off like something that's $50 30 or 60 days later, that's a very easy thing to do. But having a consistent and strong credit report where you've paid back all these lenders, mortgages, auto loans, credit cards over the last 10 years, that is much more difficult of a feat, right? And that really is like your financial report. So that's what banks are going to go off of because that's how they get the most accurate data to you. Not so much you buying like a course that taught you how to set up, your paydex score to 80 or higher. It will actually get built naturally by you borrowing the banks. And you borrowing money from the banks really needs to start with you having good personal credit. Honestly, that's kind of where it all gets.
Exactly. So this what was going on, right? When I first got into credit back in, I started fixing my credit back in 2018, then start dabbling into business credit around 2019, 2020. With me, I was hearing all this net 30 stuff, but then, I talked to a couple bankers and they're like, yeah, bro, we don't care about your payday score. Right. So I've been saying this for 5 years, right? And people try to push back on it, but I'm like, it doesn't really make sense. Why would the bank give you 50K credit card with a business credit card when your personal credit's a 500? That doesn't really make sense, and they just what you said earlier, people will believe what they want to believe, right? So they want to, yeah, they believe what they want to believe, right? So that was perfect. So what if a person was just starting out, which bank do you think they should start off at?
That's a really good question. Excuse me. I like Chase Bank personally. Like that's just my personal preference. I do all of my banking with Chase. So Chase, and are you asking like for business funding specifically?
Yeah, for business funding, specifically, yeah.
Yeah, I like Chase Bank, and the reason why is because there's different tiers of funding products, right? So there's like business credit cards. Business credit cards are awesome. They're kind of the low-hanging fruit funding products. There's business lines of credit. There's business loans. And usually, if you're just starting out, meaning you're probably a startup, you're probably going to want to go for the business credit cards versus the lines of credit or loans. So a lot of people don't like the credit cards because they're credit cards, right? They're not cash.
Yeah.
Which I'll explain that in a second as well. But let's just focus on the funding products right now. Banks don't really like to lend cash to new businesses because if you send a wire transfer, you're not getting that money back.
Exactly.
If you get scammed, you're done. The bank is losing money, you're losing money. Some scammer has it now. Whereas if the banks give you a business credit card, you can always call the number on the back of the card and dispute it if you really need to. So credit cards actually are more protection for you and for the bank. Not to mention, they could be 0% interest from 12 to 18 months, and they give really awesome rewards, which is like amazing.
Yeah.
So credit cards are really good for startups, and I always recommend going for the 0% business credit cards if you can, just because it increases your margins as well. If you have 0% interest for 12 to 18 months. And Chase historically has been probably the most generous bank with 0% interest business credit cards. The Chase Inc. Unlimited, the Chase Inc. Cash, either of those cards are amazing. I do recommend always like keeping your credit strong before applying for those cards. But yeah, Chase, US Bank can be good. Amex can be good, especially if you have a relationship already with Amex. But Chase is definitely my number one.
Okay. So you mentioned business credit card and lines of credit. Can you break down the difference for the viewers?
Yeah, exactly. Yeah. So a credit card and a line of credit are both what you call revolving accounts, meaning you can, kind of like a credit card, you can swipe it, pay it back, swipe it, pay it back. And as long as you pay it back, you're basically replenishing that, $10,000 limit that they gave you. You can borrow. It's like a loan, for example, is an installment account. So it's like you just make your monthly payments until the loan's paid off, and then once it's paid off, you're done. There's no like swiping it, paying it back. So credit is kind of a unique funding product in that way, where as long as you're paying it back and replenishing it, it's a line, right? So you can keep drawing from it again.
Okay.
Well, the difference between a credit card and a line of credit is that a line of credit is actual liquid cash, whereas a credit card is a piece of plastic. Most of us probably know what a credit card is. A lot of us probably don't know what a line of credit is. So a line of credit, I have a $50,000 line of credit for one of my businesses with Citizens Bank out in New Jersey. And I can actually call Citizens Bank and say, hey, I need to draw $35,000 for my line. They'll actually just ACH me $35K straight to my business checking account, which is with Chase. So it's cash that I can use for pretty much whatever I want.
Okay.
And then again, the banks are a little stingier with cash if you're a new business.
Yeah.
But for like our real estate investors and things like that out there, you can convert credit cards to cash as well through a process in the industry known as liquidation.
Yeah.
Don't try it at home. If you have questions on liquidation, like drop them here, and I can answer those. But essentially, you can convert credit to cash as well without doing like a cash advance and keeping that 0% interest period.
Okay.
Yeah.
What's the most common, in your experience? What's the most common thing that gets people denied, like a nice, 0% business credit card? Like, what's the number one reason that you've seen that people get denied?
That's a good question. It just like. I think the most common reason is going to be negatives. So like late payments, collections, charge-offs, just anything in that, like payment history. Because if you look at payment history, that's 35% of your FICO 8 score, which is the credit score the banks look at. So that is by far going to have the biggest impact on your credit report. And I think that most people who apply, they just apply for credit. They don't really prepare to apply for credit. They just need the money and they apply. They get a hard inquiry, they get denied because they're not educated on what the banks are actually looking for. So I think negatives are going to be the number one reason people get denied. As for myself, kind of in the atmosphere I'm in, the reason is going to be more commonly utilization. Because I know that for people in the funding space, like they're not going to work with you if you have, a collection on your credit report. You go to credit repair, you get that removed, and then you work with a funding company. But people in my space, when it comes to credit utilization, it could be a little bit more of a gray area, right?
Yeah.
We're like, you're at like 31% utilization.
Yeah.
Right on the border of like banks are about to auto decline you. In which case, some credit, their funding companies, they might be like, well, we can run it. Like we can go ahead and shoot our shot and see. And then sometimes the banks will come back and say, hey, sorry, your credit utilization is too high. We can't approve you. So in kind of my space, I see a lot of denials for utilization. But I think out there in the world, it's going to be the negatives.
Okay.
More so.
Yeah. That's what I talk about. That's pretty much what I say too. So when it comes to utilization, are they mainly looking at your total utilization or individual accounts, like your individual utilization on those credit cards?
Yeah, that's a really good question as well. And my answer to that is going to be it's both.
Both. Yep.
Most funding companies will probably say total. And I believe that your total utilization is the first thing you should look at. Like that's, I guess, the most important. You do want to get your total utilization down. I recommend under 25% at least. The industry standard is under 30%. Okay, so 30%, is kind of enough to pass. 25%, now you're starting to get into like unsafe territory, right? And it's really going to be your total utilization that the banks are looking at. However, that being said, I have seen denials happen because everyone's, they have their credit cards paid down, but then they have one like 10K Chase card, and that card's just maxed out. So their utilization is, 22%, but they have one completely maxed out card, and lenders will also deny for that.
Okay.
So I always tell people, focus first on getting your total utilization down under, 20% is kind of my rule. And then also, if you're going to be paying down your cards, pay down each individual card.
Yep.
Under, 30, 25%, whatever rule you want to follow. Again, different people out there will say different things, but I like to see all cards under, 25%. That's what I look for personally.
Okay. Perfect. So honestly, you were the first one when we're going over the requirements and stuff. You were the first one that said that a late payment that you can still get people approved with a late payment that's over 2 years old. That's 2 years old or over. That was the first time me even seeing that before. So how come how come that older late payment is okay, but not a newer one?
Yeah, that's a good question, and experience and data, right? So I've trips on funding, and I've had people tell me like, utilization has to be under 30%, or late payments have to be over 2 years old, or this and that. And as I've worked with so many different clients and tried so many different things, truthfully, I've seen it all. Like I'm seeing a lot of clients saying percent utilization should be the difference.
Yeah.
Okay? And that's, look, you can get it under 5%, do that. Rather see that than 20%.
Exactly.
Paying business funding with 25% utilization,
Okay.
and that's just the truth. And they've had very good credit profiles otherwise. Funding, 0%, 50K Chase business credit cards with a late payment that's 2.5 years old. Now, I still would recommend.
Yeah, of course.
But I've worked with clients in all kinds of different demographics and different kind of shapes of credits. And credit and business funding, they're very fluid things. So I personally try not to stick to rules that are too black and white.
Yeah.
But if a late payment is older, generally what that tells the banks is you maybe were in some sort of financial hardship, potentially, in the past. Whereas if you get a late payment that's like a month old and you go apply for business funding today, they're going to be like, why are you missing payments right now? Like, are you having a hard time making payments right now? Because if so, lend to you. So the newer late payments are pretty much always going to have a harder impact on your credit and business funding than something that's older. But the truth is, the cleaner your credit.
Of course.